Hello, my dear students. Welcome to this video lecture. This lecture is for the fourth semester diploma in engineering, mechanical production RAC plastic at the Aligarh Muslim University, Aligarh. The course code is BME 601 and the course title is Industrial Management and Entrepreneurship Development. In this lecture, we will be talking about Unit 2. If we have a look at the syllabus, we have already completed Unit 1, which comprises of industrial management and industrial ownership. As far as Unit 2 is concerned, it's divided into two parts. The first part is related with the financial management, and the second part is related with the wages and the incentives. Today in this lecture, we will try to cover as much as possible of the financial aspect or the financial management part. In this, we'll be talking about the sources of finance, the elements of costs, prime cost, factory cost, other overheads, total cost, selling prices. Moreover, we'll be discussing some problems or numericals. After that, we will discuss what is depreciation, how it is classified, and how many types of depreciation methods are there. And also we'll be doing some problems on it. So the first part is financial management. For any business, it is important that finance is invested in a manner that it returns from the investment at higher than the cost of finance. In a nutshell, financial management is endeavor to reduce the cost of finance. It also ensures sufficient availability of funds whenever it is required. And last but not the least, it deals with planning, organizing, and controlling the financial activities like the procurement and utilization of funds. So if we look at any business, the prime objective in most of the cases is to earn profit or to get more money which is being invested. So in order to have this objective fulfilled, we need to manage the finances. That is what we will be discussing in this unit. So the second topic that comes under this syllabus is what are the sources of finance, both for the large industries and for the small industries. So when we talk about sources of finance in a large industry, so we can classify these sources of finance in three categories. Like, what are the sources of finance we need for short term, the middle term, and the long term. Short term consists of mainly up to 1 year. What are the sources of finance that can be utilized in coming 1 year? If we need the finance for 1 to 3 years, it comes under middle term, and the long term is 3 to 5 years. So there are many sources of finance that can be availed by the businessman. For example, first is equity share. The key feature of equity share is sharing of ownership rights. The return is in the form of dividend or bonus shares. A businessman can float his shares, people can get equity share, but the thing is that the key salient feature of this is that they will be getting ownership right in that business. Other one is debentures. Debentures is considered to be the cheapest mode of finance compared to equity. It does not share control with investors. Then there is term loan. It is given by some banks or financial institutions. These loans are also secured by some assets, what we call mortgage. Then there is a preferred stock. The characteristics of both equity stock and debt, they got priority over common equity shares in terms of payment. They will be getting the payment first, then the one which is in equity. Then there is venture capital. They are normally invested in a new company or entrepreneurial venture at the initial stage, so to do a rigorous analysis of a company before investing. In the short term sources of finance, there is a bank overdraft, trade credit, and debt factoring. You can read about these sources in the literature or the reading material that I have uploaded on my web page. Similarly, there are many sources of finance for small industries also. First is own capital. A individual or a partners, they can invest their own money, or they can borrow money from their family and friends, or they can get a loan from bank, or they can have a equity, or they can get a venture capital, or there is one more concept which is coming, that is called crowdfunding. It is mostly done on the internet, where the people or the general public, they invest in the business with a very small amount. It's called as crowdfunding. Now the next topic is cost. So when we talk about cost, if we are into producing or in a manufacturing or in any business, we need to know about the cost of the product. We need to evaluate, or we need to assess what is the cost of our product. A cost may be defined as the amount of expenditure incurred on a given thing or a product. You need to know how much you have invested in that product. In business, cost is usually a monetary valuation of, the cost is what? It is a monetary evaluation of, number one, effort. How much effort you have put in that product? How much material you have put in that product? How many resources are being used for producing that product? How much time is consumed? How much risk is incurred? How much opportunity have foregone, and the delivery of goods and services. So all these efforts or points are taken into consideration while we calculate the cost of any product. In business, the cost is usually, as I told you, the monetary valuation of efforts, material, resources, time. So as we have discussed, the cost is the total amount of money that we have incurred on a product, and it is absolutely essential for any business to know the total cost of a product, so that they can find out the selling price and they can earn a profit. As far as the elements of costs are concerned, it can be divided into three groups. First is the material cost, second one is the labor cost, and third one is the rest of the expenses apart from material and labor. These three groups can be further subdivided into two groups, which are direct cost, that is direct material cost, and the indirect material cost. Similarly, direct labor cost and the indirect labor cost, and the direct expenses and the indirect expenses. Direct labor and direct material means If the money is directly related with the product or it has been spent directly on the manufacturing of the product, it is known as direct material cost or the direct labor cost or the direct expenses. For example, if we are making a hexagonal bolt or hexagonal nut of mild steel, so mild steel will be the direct labor, direct material. But for manufacturing a hexagonal nut or hexagonal bolt on any machine, you need a grease for the lubrication of the machine. It is not consumed directly by a nut or a bolt, but it is used indirectly. So, similarly, a labor, a one operator which is operating the machine who is manufacturing nut and bolt is direct labor cost. And for example, a supervisor who is supervising many other products apart from a nut and a bolt will be indirect labor. Similarly, expenses which are directly spent on that product is a direct expense, and the indirect are factory overheads, administrative overheads, and selling overheads. So, to summarize, the cost which is incurred on physical substance or a thing, for example, components, raw material, are the material cost. The cost incurred on the human efforts, for example, salaries, wages, bonuses, incentives, retirement benefits, and prerequisites, they are the labor cost. And the cost incurred for services, expenses are other than material and labor are covered here. For example, electricity expense, rent of a building or a rent of any machine, anything, or a telephone is a um, expense. Now, the next topic is the components of the cost. What are the different components of a cost? So, as we have already discussed, there are three elements of a cost. For example, direct material cost, direct labor cost, and direct expenses. These three direct costs, they are summed together to give the prime or direct cost. When in this prime cost we add factory expenses, we get factory cost or works cost. And when on this factory cost administrative expenses are added, they become office cost. And if selling and distributing cost is added to this office cost, it becomes the total cost or the selling cost. And on top of it, if we add the profit we want to earn or the loss we can bear, it becomes the selling price of a component. So these are the different components of a cost. Now let's discuss few simple problems on cost so that we are able to get a clear picture. The first problem is a factory producing 150 electric bulbs a day involves direct material cost of rupees 250, direct labor cost of rupees 200, and factory overheads of rupees 225. Assuming a profit of 10% of the selling price and the selling on cost or the overhead 30% of the factory cost, calculate the selling price of one electric bulb. So the data that is given to us is direct material cost, direct labor cost, and factory overheads. We add these three together to calculate the factory cost. It comes out to be rupees 675. As we have already discussed, to calculate total cost, we have to add selling overheads in the factory cost. and the selling overheads is 30% of the factory cost. It is given in the problem. So the total cost comes out to be 877.50 paise. Now we also know that the total cost is equal to selling price minus the profit. That is SP minus SP, the 10% of the selling price is given. If we compare equation 1 and 2, we can compute the selling price, which comes out to be 975 rupees. It is the total selling price. And if you want to find the selling price of one bulb, since we are producing 150 bulbs, so it will be 975 divided by 150. It comes out to be rupees 6.6 rupees 50 paise per bulb. So this problem is very simple, and it is based on the direct formulas that we have discussed in the components of cost. Let's discuss another problem. Two molders can cast 25 gears in a day. Each gear weighs 30 kg and the gear material costs rupees 12.50 paise per kg. Rupees 12 rupees 50 paise per kg. If the overhead expenses are 150% of the direct labor costs and two molders are paid rupees 70 per day, calculate the cost of producing one gear. So we have to calculate the total cost first. The total cost is material cost plus the labor cost plus the overheads, as we have already discussed. To calculate material cost, it is given that we have to produce 25 gears. Each gear is 3 kgs and the material cost is rupees 12.50. So 25 into 3 into 12.5 gives the total material cost. The labor cost is rupees 70 per day. It is added to the material cost, and the overheads are 150% of the labor cost. It's given in the problem. So when we add three of them, it comes out to be 1112.5. This is the total cost. So the cost per gear is total cost divided by number of gears, which is 25. So the cost of one gear comes out to be rupees 44.50. In the similar way, you can do few practice problems I have already given in this presentation. You can try and solve them. They are very simple based on the components of the cost. So the next topic in financial management is depreciation. We have heard this term a lot of time. Depreciation in simple words means that the value of any asset keeps on decreasing with the passage of time. The formal definition is depreciation is defined as a reduction of recorded cost of a fixed asset in a systematic manner until the value of the asset becomes zero or negligible. Examples of fixed assets are buildings, furniture, office equipments, machinery, etc. So the value of all these assets keep on decreasing as the time passes. An example of depreciation is if a delivery truck is purchased by a company with a cost of rupees 10 lakhs and the expected usage of the truck is 5 years, The business might depreciate the asset under depreciation expenses as rupees 20,000 every year for the period of 5 years. Sorry, 1 lakh. So if the cost of the truck is 1 lakh and the life is 5 years, so every year 20,000 will be depreciated. This is simply depreciation. The causes of depreciation can be classified into two groups. One is internal, other one is external. Internal means there is a wear and tear in the asset. It is exhaustion, depletion, deterioration. The external causes are a fraction of time. With the passage of time, the value keeps on decreasing. It becomes obsolete. There is weather and natural calamities and the permanent fall in the market value of an asset. These are the different causes of depreciation. There are various methods for providing or calculating depreciation. The one that are in our course are straight line method, number one. Number two, reducing balance method. Number three, production based methods per unit and per hour. Next is annuity method, and last one is sinking fund method. We will discuss each method one by one. The simplest and the easiest method for calculating depreciation is a straight line method. This method, the simple concept is the depreciation will be linear in nature. Every year it will be same. Under the straight line depreciation method, the division of the cost of an asset is equal during its useful life. So every year a fixed amount of money will be depreciated. It has certain advantages and certain disadvantages. It is the simple advantages are it is simple method. Asset can be written off easily. Total depreciation charge is known and it is suitable for small businesses. But there are few disadvantages also. Disadvantages, there will be a pressure in the final years when the serviceable life of the product is about to end and you have to give the same amount of depreciation cost as you were charging when it was new. So this method can be used for calculation of tax deduction and for accounting purposes mainly. As far as mathematically, straight line method, the annual depreciation charge ADC can be calculated as C minus S divided by N, where C is the original cost of an asset, S is the scrap value or the residual value at the end of its useful life. What is the value after it has been it after it has finished its serviceable life, and N is the serviceable life in years. So let's discuss one problem based on this straight line method. The problem is a melting unit of a steel foundry was purchased for rupees 30,000. Rupees 5,000 more were spent on its erection and commissioning. The estimated residual value after 10 years was rupees 7,000. Calculate the annual depreciation rate. Number two, determine the depreciation fund collected at the end of 7 years after the purchase of the melting unit. So the original cost of the melting unit is 30,000 plus 5,000 was installed for erection and commissioning. The total cost will be 35,000. The scrap value or the residual value is given as after the useful life is rupees 7,000. And number of serviceable years N is 10. So the annual depreciation charge by the straight line method will be C minus S divided by N, that is 35,000 minus 7,000 divided by 10, which comes out to be 2,800 rupees annually. And if you want to calculate the second part of the problem, We have to calculate the depreciation fund collected at the end of 7 years. It comes out to be 2,700 into 7. It comes out to be 19,600 rupees. The next method is a reducing balance method. It is also called as diminishing balance method or percentage on book value method. The main difference between the reducing balance method and the straight line method is, in the straight line method, as we have discussed, the depreciation is calculated on linear basis. Every year the depreciation will be fixed. But in this case, in reducing balance method, it is not fixed, but it is based on certain percentage on the book value of the product, yeah, asset. And the basic philosophy in this method is, in many cases, the cost of maintenance of an equipment, that is the fixed asset, increases towards the end of its life. The maintenance increases towards the end of the life. Therefore, it is sometimes considered desirable to calculate depreciation so that the charge lessens towards the end of the asset's life, thus roughly equalizing the combined charge of depreciation plus the maintenance over the period. So to balance the maintenance at the end of the serviceable life and at the start of the serviceable life, there is a certain percentage on the book value to calculate depreciation. And it can be calculated by this formula: P is equal to 1 minus S divided by C whole raised to power 1 upon N. So we'll discuss another problem based on reducing balance method. An old car was purchased for rupees 32,000. Its life was estimated as 10 years and the scrap value is rupees 18,000. Using reducing balance method, calculate the depreciation rate. Number 2, estimate the depreciation fund at the end of 2 years. So we have the data which is given to us is scrap value is 8,000. It's not 18,000, it's 8,000. And the total cost is rupees 32,000 and N is 10. So the percentage of depreciation can be calculated as 1 minus 8,000 divided by 32,000 to the power 1 upon 10. It comes out to be 12.94%. This percentage will be on the book value of that asset of the car every year. So the value of the car at the end of the 1 year will be C1 is equal to C into 1 minus N, that is 32,000 into 1 minus 0.1294, which is calculated as percentage. It comes out to be 27,859.20 paise. And the depreciation fund at the end of 1 year will be 32,000 minus the value of the car. It comes out to be 4,140.80. Similarly, the value of car at the end of second year will be C2. Total value at the end of second year will be, it will now calculated on C1, the value of the car after the first year, not the original value that we were calculating in the straight line method. So it comes out to be, C2 comes out to be 24,237.50. So the depreciation fund for second year will be this value after the first year minus this, it comes out to be 3,621.70. So the depreciation fund at the end of 2 years will be, now we will minus it from the original cost. So it comes out to be 7,792. The same can be obtained by adding 1 and 2. It comes out to be 7,762.50. So we will discuss the rest of the methods for calculating depreciation in our next class. Thanks for listening, and I will see you soon.